If you never want to buy another stock again, but still want to build some serious wealth, this 3 ETF setup is your golden ticket. It's simple, set it and forget it, and it outperforms most Wall Street professionals. So in the next 10 minutes, I'll walk you through this 3 ETF portfolio that can be set up on autopilot, that can build some serious wealth over time, including a powerful tweak to turn stability into steady income, and how to set the whole thing up faster than your morning coffee. If that sounds helpful, please do me a favor and drop a like. It helps me get this video out to more people, and it'll help me continue making free videos for you guys. Alrighty, let's dive in. This is the time-tested classic 3-fund portfolio. It's simple but yet powerful, made up of a broad US stock ETF, an international ETF, and a income ETF. But I'm gonna mix it up just a bit. Instead of locking you into specific tickers, I'm gonna break this portfolio down into flexible buckets. So you could either stick with the original ETF picks, use the ones that I prefer to use, or plug in your own favorites. So with this 3-fund portfolio, there's no stock picking, no pricey wealth advisors, just super clear framework that'll help you put it on autopilot. But here's the burning question we'll answer. Can something this simple really get you to financial freedom faster than those so-called expert stock picks? Buckle up because your blueprint starts now. Category number 1, Broad US ETF. The standard traditional choice for this bucket is to go with a total market US ETF like VTI. VTI is like a buffet table of nearly 4,000 companies, from mega caps like Apple down to these tiny micro cap companies that you've never heard of. This essentially gives you exposure to the entire US stock market. You get both the good and the bad, but the idea is that the good will outweigh the bad, which is why it tends to trend upwards over time. There will be some years that VTI will go down, but the majority of the times it will go up. Now, you can absolutely stick with the total market ETF like VTI, which gives you a slice of nearly every publicly traded US company. But in my version of this portfolio, I personally prefer to swap it out with something like the S&P 500 ETF like VOO. Why? Think of VTI as like a giant sampler platter. You get a bit of everything, from the good to the bad. But switching to VOO is like going straight to the chef's top rated picks. You're focusing on the 500 largest, most established companies, generally higher quality, more stable, and time tested. Sure, not every single one of these will be a winner, but the overall caliber is better. So basically what we're doing is going from the exposure of 4,000 companies down to just the top 500 companies. Now, you're still getting broad diversification, but amongst the diversification, they are higher qualities. So let's take a look at the performance between the two. Over the last 3 years, VOO returned 8.99% annually over VTI's 8.09%. Over the last 5 years, VOO returned 18.56% versus 18.09%. And then lastly, over the last decade, VOO returned 12.46% versus 11.74%. So we can see that picking the S&P 500 ETF over the total US stock market ETF will return slightly more over time, all while having these same characteristics like category, risk potential, and expense ratio. Now, if you don't want to use either of these and prefer to pick your own ETF, make sure you're selecting an ETF that focuses on large cap companies in the US. This first category of your portfolio is the main engine for growth, so it deserves to have the heaviest allocation. In fact, if you could only pick one ETF to build your entire portfolio around, this would be the one. Category number 2, International ETF. The standard choice for this bucket is to go with the Vanguard Total International Stock Index ETF, ticker symbol VXUS. And the idea around this is to give your portfolio exposure to the rest of the world beyond the US, with one single fund that includes thousands of companies from both developed and emerging markets. From Nestle in Switzerland to Samsung in South Korea to fast-growing firms in India, Brazil, and China. VXUS lets you tap into global growth and diversify your risk beyond one country's economy. You could also use Vanguard's FTSE Developed Markets ETF, ticker symbol VEA. This ETF serves the same purpose, but just targets developed countries only, as opposed to VXUS that's doing both developed and emerging markets. Some examples of developed countries are Canada, UK, Germany, France, and Japan, while some examples of emerging markets are China, India, Brazil, and Mexico. So VXUS will give exposure to both developed and emerging markets, while VEA will only give you exposure to developed markets. Let's take a look at the data. A study conducted by Vanguard shows that adding international equity is expected to reduce the total volatility of a portfolio across markets. For example, when you add 25% allocation to non-US stocks, you could see as much as a 2.5% reduction in portfolio volatility. But any more than 25%, the marginal benefits begin to decline. By adding international exposure, we not only get diversification and reduction in volatility, but we could also see this potentially help our portfolio generate excess returns. In fact, Vanguard's updated 10-year annualized return projections for US equities are 2.8% to 4.8%, while global equities excluding US and developed markets are expected to return at 7.3% and 9.3%. Category number 3, Income ETF. Growth is great, but what cushions the fall when markets take a nosedive? That's where the third leg of our portfolio comes in, acting as a shock absorber. This last category's purpose is to help smooth out volatility and soften the blow of crashes. And that has historically been done by using bonds. The go-to choice over here is BND, Vanguard's Total Bond Market ETF. This holds over 10,000 US treasuries, mortgage-backed securities, and investment-grade bonds with an average duration of around 6 years. And it pays out a nice dividend of around 4.5% for some steady income. In 2008, while stocks dropped 37%, BND rose 7%. And while during the COVID crash, the S&P 500 dropped 34%, meanwhile, BND dropped only about 2%. So it does its job pretty well, but there's a trade-off. The 10-year return for BND, just 1.45% annually, barely even above inflation. The problem is that bonds are extremely underwhelming, but eliminating bonds out of the 3-fund portfolio entirely can feel like skydiving without an emergency parachute. So here's the question. Can we cushion market crashes and boost our income without relying entirely on bonds? Let's introduce our modern alternative and my personal choice for swapping out BND, Schwab's US Dividend Equities ETF, ticker symbol SCHD. It's packed with 100 high-quality dividend-paying stocks, companies like Coca-Cola, Pfizer, and Home Depot, which all have strong balance sheets and consistent cash flows. This ETF produces a generous 4% dividend yield, all while generally being less volatile than the overall market. While it barely held up any better than the S&P 500 during the COVID crash, it did do significantly better in the 2022 bear market, with the S&P 500 down 17%, while SCHD was only down 5%, all while producing a modest dividend. They've also been consistent on increasing the amount of dividend paid out each year. Let's take a look at the annualized return. SCHD returned 4.49% over 1 year, 4.58% over 3 years, 12.76% over 5 years, and 10.47% over 10 years, which is almost similar to the returns of VTI over the last 10-year period, which is pretty impressive, especially also giving a modest dividend on top of that. Now, of course, this is not risk-free in any means. SCHD still holds stocks rather than bonds, so in a 2008 style meltdown, it could slide 20% or more. Now, you can absolutely stick with BND. However, I am personally comfortable with taking slightly more risk to get a better outcome. Now, if you don't want to use the classic BND pick or my personal preference for SCHD, you can certainly pick your own ETF. But make sure to focus on income and stability. Don't just look at an ETF that gives the highest dividend yield. Another alternative I like is HDV and VYMI, which both give a modest dividend while being less volatile than the overall market. Allocation. Now that we've covered the 3 categories in our 3-fund portfolio, whether you went with the original ETFs, my preferred ETFs, or your own, let's now talk about allocation, aka how much to put into each category. Now, you could just do 1/3 into every single category and just make it super simple and call it a day. But if you truly want to optimize it, we can adjust our allocation accordingly to our risk profile and our age. So here's how I would do it as a young, aggressive investor in his 30s. Category number 1, the Broad US ETF. This will make up the lion's share of the portfolio, as this will be the main growth driver. I would personally put this at 50 to 60% of the portfolio into this specific bucket. Category number 2, the International ETF. I would personally put 25% into this category, because remember that same Vanguard study that we referenced earlier, showing a 25% allocation towards non-US stocks will hit peak reduction in portfolio volatility? Any more than 25%, we start to see a decline in the benefits. Category number 3, the Income ETF. The remaining allocation would go towards this category, so that would be anywhere from 15 to 25% of the portfolio into this specific category. Now, if you are older or have a lower risk tolerance, you can adjust this category to be a little bit more. So let's recap. With just 3 ETFs, you've built a globally diversified portfolio that taps into the full power of US large caps for growth, adds global diversification to reduce risk and capture opportunities outside the US, and includes an income component to cushion crashes and generate steady cash flow. You've seen the historical returns. Even a small tweak can make a 6-figure difference over time. And the best part? Once it's set up, this portfolio runs on autopilot. No consistent tinkering, no FOMO trades, and no guesswork. This isn't about timing the market. It's about time in the market with a strategy built to last. I put a lot of time and effort into making this video, so if you found this helpful, please do me a favor, drop a like and subscribe if you want more content like this on building wealth the simple and smarter way. And if you're ready to go one step further, check out this video over here where I break down the first $100,000 wealth building in 7 steps, and I'll see you there.